It's time for Yahoo Finance's Market Minute. Stocks poised to close in the green as investors hope trade negotiations will begin to take shape. Walgreens topping Wall Street estimates in its latest quarter, the drugstore chain benefiting from cost cuts as it prepares to go private in a $10 billion deal with Sycamore. Broadcom shares surging after launching a new $10 billion share buyback program. Broadcom CEO saying the move represents the company's confidence in its business and position in the AI space. Shares of CVS jumping as the company taps a new CFO, saying it will meet or exceed its latest full-year guidance. CVS also rising alongside other health insurance names as the U.S. announces that Medicare plans could get a $25 billion boost in 2026. That's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts are going to give you the tools, the resources, the tips, and the tricks that you need to grow your money. Hey, on today's show, Portfolio Checkup. An expert talks about what investors should be focusing on instead of when the market will bottom. And we've got small business sentiment posting its largest monthly decline since 2022. We'll talk about the impact of tariffs on the results and small businesses. Plus, maybe time for you to delay major purchases and build a cash reserve. We'll talk to a wealth advisor about different strategies to navigate market uncertainty. All that and much more coming up during this hour. But first, let's take a look at some of the market action 90 minutes into the trading day. Stocks rebounding today on growing hopes of tariff deals. This following 3 days of steep losses. Joining me now on set, we've got Bryant Van Cronkite, who is the Allspring Global Investments Senior Portfolio Manager. Great to have you here in studio with us. So you say investors shouldn't be focused on timing the market and when the market will bottom and when that will happen. So what should they be watching instead?
Yeah, it's one of the most common mistakes we see. Whenever there's risk or fear escalating, we see people trying to figure out when are things going to happen? When are the negotiations going to start? When should I get into the market? Instead, the focus should be on what is going to happen. And it seems pretty clear to me, though, what is easier to solve for right now. For example, we're probably going to have some economic strain as consumers and businesses adjust to the new landscape, adjust the uncertainty. We're probably going to see that clear path for the Fed to cut rates eventually, not right now, but eventually, and that's going to drive action in the market in a certain direction. Let's understand that and start thinking about that long-term plan as opposed to trying to guess the near-term whens of the problem.
Markets always try to look out to the future as far as possible. And so when we see any type of downturn, on the way down, it's the uncertainty about what could take place in the future. But then once we eventually do see a bounce, or in some cases a dead cat bounce, it's giving us a little bit of the inclination as to how far out the markets could be looking or adjusting for. How far out is that in your estimation as of right now, based on some of the bounce that we're seeing here today?
Yeah, this is still going to be messy, I think, right? We're going to have to go through some ups and downs still. We're going to see some turbulence when it comes to earnings season coming up. We're going to hear CEOs and CFOs talk about how they're not really sure what to do, but they're going to navigate this. What we're looking for right now are companies that have a horizon where they can invest through this downturn, not around this downturn. And so think about a company that's going to have a 12 to 36 month mindset. They're not going to pull back on smart investments just because there's some uncertainty, a bump in the road. So I'm thinking 12 months out plus. And I think investors should begin to think about moving capital methodically with that mindset as well.
I was thinking about some of the projections that we had seen for earnings growth for Q1 2025, and from FactSet, they had said the estimated year-over-year earnings growth rate for the S&P 500, 7%. If 7% is the actual growth rate for the quarter, it's going to be the 7th straight quarter of year-over-year earnings growth reported by the index here. What needs to take place? What needs to be heard from the street about what the outlook going forward? It's not just what they're reporting, but also in the guidance. That's the key.
I actually think what they report is less relevant right now. It is the outlook. And if you go out as a CEO, CFO and say, I haven't figured out, this is what's going to happen, you're not going to gain credibility. I think what investors want is a clearing event. Right? If you look at the overall market right now.
What does a clearing event look like? Does it mean pulling guidance? Does it mean just resetting expectations?
It's resetting expectations. I don't think you want to cause panic and say we have no idea what to do. What you want to say is, look, the near term is a little bit more unclear to me. What we're going to do, though, is we're going to continue to use our balance sheet to buy back stock under pressure. We're going to continue to grow our dividend for those investors who want that. We're going to continue to invest strategically around these key initiatives that no matter what happens in the next 12 months, next 36 months, we're a bigger, better business because of it. And that's what we're going to focus on. So we want to see expectations be calibrated down and allowing us to build up that base going forward.
Within that, what's the key word? What do you think the theme is of the common denominator that emerges this earnings season?
Well, I think we're going to hear the word uncertainty a lot.
Sure.
Okay. Then from there, what I think we want to hear is strategic importance. Okay. I want to hear companies talk about what matters to them. The last thing you want to do is cede control as an investor to the things we can't predict. The changes in GDP, the changes in inflation, the changes in tariffs. But what I can predict with confidence is how this company is going to invest in growing their future value and how they're going to control their own destiny. So what I'm looking for is what's strategically important to you, why, and let's walk through how we're going to methodically build to that game at the end, over the next several quarters.
For investors who are trying to figure out what their playbook is, as they began the week hearing about, we could potentially enter into a bear market, and now they're looking across some of the areas that have been beat down within the market and trying to figure out their time horizons and where it makes sense to add into some positions. Where does it make sense to fade a trade versus lean into a trade at this point?
So let's talk about what is going to happen. We said the when is tough, but the what's a little easier, right? So as the Fed and as the market mechanisms come back into play and kind of restart the economy off of whatever trough that happens to be, we're going to see rates move lower. We're seeming to see a shift in support for the middle to lower income wage earners, right, the blue collar workers, and that's going to be done through pushing down mortgage rates, pushing down auto loan rates, pushing down credit card rates, and those consumers are going to have the ability now to use lower cost of capital to advance their initiatives in life. You're also, I think, going to see a tax bill that favors no tax on tips, no tax on Social Security, deductibility of car debt on car purchases. These are all tilted one direction, and so we want to begin to move capital into things like home builders or companies that benefit from building supplies. We want to move capital into companies that ultimately are going to see that lower end consumer re-accelerate out of what's been a bit of a slump for them. Yeah. Right? And that's what we're looking for right now.
Any specific names within that thesis?
Absolutely. So the largest home builder in America, D.R. Horton, to us has gone through a strategic shift in how they run their business over the last 3 years. That shift is ongoing. There's a massive pent-up demand for house development. We're under-housed here in America. They're in the leading position. And even if costs go up for them, they're going to be in a better position to buy at lower cost than all the other peers, and they're likely going to see share gains through that. Sherwin-Williams applies the paint to homes. We're going to see housing turnover reaccelerate as rates come down as well. So on the building product side, I like that. I also think healthcare is interesting for other reasons, but another place to start dabbling as well. All
right, well, we're going to continue the healthcare conversation in just a moment, so you're teeing that up perfectly. Bryant, thanks so much for taking the time here with us.
It's always a pleasure.
Investors have collectively lost $10 trillion since President Trump's Rose Garden address unveiling his tariff plans, and the richest among the U.S. billionaires are shedding massive amounts of wealth. But one standout among the billionaires, Warren Buffett. Buffett's net worth has grown by $11.5 billion this year for a total of $153.5 billion, making him the fourth richest person alive, according to Bloomberg's Billionaires Index. A majority of Buffett's net worth is derived from his shares in Berkshire Hathaway. Berkshire outperforming the S&P 500 year to date. It's up more than 10% versus the index's more than 10% decline. The market downturn comes at an interesting time for Buffett, who is sitting on a $334 billion cash pile, a decision he defended in his annual letter to Berkshire shareholders in February. He didn't mention tariffs or predict any market turmoil in the letter, but in a March interview, he did call tariffs a, quote, act of war to some degree. He has also heavily reduced his position in Apple, trimmed his holdings in Bank of America in 2024. Both of these stocks down double digits year to date. Other billionaires are not faring well in 2025. Tesla CEO Elon Musk, the richest man alive, has lost more than $134 billion. Recent declines pushed Musk's wealth below the $300 billion mark. Amazon executive chairman Jeff Bezos has lost more than $42 billion, and Meta CEO Mark Zuckerberg has lost over $24 billion. Health insurance stocks are rising after a larger than expected increase in the government's reimbursement rates for Medicare Advantage plans. Yahoo Finance's senior health reporter, Angelika Milani, has the story. Hey, Anj.
Hey, Brad. Yeah, so good news for, of course, those Medicare Advantage plan stocks. That includes Humana, United Health, Elevance, as well as CVS with their Aetna insurance product. And so this is good news because what was proposed by the outgoing Biden administration was a 2.2% 3% increase in the payments, and now under the Trump administration, this has jumped to 5.06%. What that means is that Medicare is going to be paying out $25 billion more to these names that I just mentioned, and that is good news for, of course, these companies. But we are not 100% sure of whether or not the sort of attribution is for the administration itself. This is coming after a sort of data update on the utilization of Medicare Advantage and how much more was needed to cover costs, and that is why this upgrade comes into effect. So it's not so much an administration thing as it is a numbers thing.
Net, good news, bad news for everyday Americans.
Net good news. And that's because with more money coming in from the government, these insurers are then going to increase their benefits, their perks, and the types of things that we've seen sort of trimmed down, things like car rides and other medical transport and things like that. We've seen some perks really be done away with, and so it could increase with the money coming in.
Anj, thanks so much for breaking this down. Appreciate it. Coming up, everyone, we're talking about how small business owners are preparing for President Trump's tariffs. That's next on Wealth. The NFIB Research Center's monthly survey of small business owners found that optimism fell in March to a level slightly below its 51-year average. Here with more on the survey and the landscape for small business owners, we've got Holly Wade, NFIB Executive Director. Great to have you back on the program with us. So what was behind the optimism drop that was recorded?
Yes, so small business owners, as you mentioned, took a step back in optimism and how they are looking at business conditions over the next 6 months. That receded a bit as a few more were saying that they thought maybe things would worsen then get better. And also on the side of sales expectations. So after the election, small business owners were really optimistic, very enthusiastic, and expected sales expectations to improve, increase over the next quarter. And that has receded back quite a bit from the peak a couple months ago. And so those were the two components that contributed most to the downturn in optimism to just below the 51-year average of the optimism index over the history of the survey.
And so with that marker in mind, is that dip something to be concerned about?
Well, it certainly means that they're trying to navigate some turbulent water as far as how some of the tariffs or other policy adjustments will impact them. Most of the increase in tariffs won't go into effect until tomorrow. And while some of them have been in place for a couple weeks, it's still not a lot of time for small business owners to try and figure out how they need to adjust business operations. And then what it looks like more broadly as far as opportunities in investing in their business, hiring plans. We've seen that recede in the last couple months. Still a lot of job openings, but looking for, expanding their business, that's been largely on hold for February and March. We'll see where this goes going forward in the next few months, but a lot of hesitation right now.
And so on one of the points that you were just mentioning, labor, and some of the small business owners citing labor quality, I wonder to what extent you're anticipating that hiring plans will shift as a result of some of the policy uncertainty that small business owners are navigating.
Sure. So hiring plans has declined a bit as far as expanding their workforce. However, we still see very high levels historically of unfilled job openings. So those jobs that they have open, still looking to fill, they're continually having a difficult time doing that. So almost a third of small business owners in some labor related capacity, whether it's quality of labor or labor compensation, cost of labor, as their top business issue. So labor is still very prominent and a huge challenge for a lot of small business owners, especially in those more labor intensive industries, including construction, manufacturing, and transportation.
How are you seeing small businesses prepare for tariffs, and what are some of the top ways that they can kind of reshape their own operations, knowing that some of these deadlines are fast approaching?
Sure. So what we're seeing is a wait and see approach, waiting to see if they should invest in their business, how to adjust business operations, how to move forward. It's a lot of uncertainty, as your previous guest was talking about. So I think that's going to be the word of at least the next few months as business owners try to figure out what's best for their business. But on top of that, being able to have open discussions with their vendors to see what price increases might be coming their way, and what options are available to them. So, talking with vendors, looking at their contracts, really reviewing those areas of business operations that might be impacted by tariffs at their business, would be good ways to kind of fortify or create some certainty, at least in these kind of choppy waters that they're trying to navigate right now.
You have some of the top spokespeople and top officials within the administration talking about the administration being about Main Street, that being from Treasury Secretary Scott Bessent, who often says that. And what do small businesses need to hear from the administration right now to solidify that they are actually about Main Street?
Well, after the election and during the election, small business owners were really enthusiastic about the shift in dialogue as far as creating a more friendly business environment for small business owners. So lowering those regulatory hurdles that have been challenging for small business owners to deal with, and then preserving those tax provisions that most small business owners have benefited from over the last number of years, especially the 20% small business deduction. So going so far as to highlighting those areas of supporting small business and hearing small business owners hearing from the administration that those are still top of mind, still important to them in helping them better operate their business. Those tax provisions are expiring at the end of the year. So small business owners are very concerned about the potential for a tax increase in 2026.
Holly Wade, thanks so much for taking the time here and breaking down some of the survey results as well. We appreciate it. For all of you small business owners, Yahoo Finance has you covered with a small business playbook. What levies mean for you and how you can protect yourself. Elizabeth Gore is the co-founder and president of Hello Alice, a fintech platform connecting small businesses with capital, resources, and networking. She's also the host of the upcoming Yahoo Finance podcast, The Big Idea. Elizabeth, great to see you. So what are the three main ways that tariffs can impact small businesses?
Howdy, Brad. Well, the first thing is just core costs. I'm very concerned about the day-to-day operations of small businesses. If you think about the cost of foodstuffs going up at your cafe, you're going to have a really hard time keeping those prices correct. The other is uncertainty around financial planning. Most small businesses have about 3 months of cash in the bank, so it is hard for them to plan when there's this much uncertainty. And then finally, no one engages with consumers as much as a small business. Consumers are used to consistent pricing, so they're going to have some frustration and confusion with those consumers. So we're really concerned for them.
What can small businesses do to protect themselves from tariff uncertainty?
I never thought I'd be the one to say slow your growth down, but we have to keep some cash in the bank right now with this uncertainty, with prices going up and down. So slow a little bit down. Let's make sure that we don't make that higher unless we really need to. We don't purchase that new oven. So that's one. I think second, being honest with your customers, really saying, look, your price of your cup of coffee is going up. Here's why I had to pass this along to you. That way they're not thinking that you're gouging them. And then finally, there's always money where you can find it in your own hands. So cut costs where you can, really look at your P&L and see if you can conserve some of your own money in your bank account.
All right, so for all the entrepreneurs out there and the small business hopefuls, what advice would you give to someone who is looking to start a small business in this environment?
Well, you'll always hear me say, Brad, that you should start. Jump in, go for it. Just be a bit conservative. Know that you should probably have a little bit more money in the bank than I would normally tell you to start that business. Look at other financial tools like opening a line of credit in case costs do go up. Maybe be a little slower in those hires. But always jump in. The American dream is still here. We are still on Main Street.
Elizabeth, thanks so much for taking the time here with us today. Appreciate it.
Thanks, Brad.
And you can check out the premiere episode of Elizabeth's new podcast, The Big Idea, on April 24th on Yahoo Finance or wherever you get your podcasts. Coming up, we're breaking down all the different ways that you can maximize your finances amid current market volatility. Stay tuned. Stocks are rebounding today after President Trump's tariff policies wreaked havoc across markets over the last 3 trading days. According to JP Morgan, the market's best days tend to follow the worst days, with 7 of the market's 10 best days occurring within 2 weeks of the 10 worst days. My next guest says missing the market's best days can dramatically reduce long-term returns. Joining me now in studio is Preston Cherry, founder of Concurrent Wealth Management and author of the book, Wealth in the Key of Life. Preston, great to have you here in studio with us.
Yeah, thanks, Brad.
So let's talk about this a little bit, because we always hear the old adage, time in the market versus timing the market, but timing the market also has some significant benefits. Walk us through some of your analysis that you've seen about missing some of those best days after the worst pullbacks that we've seen.
Yeah, sure. I mean, portfolios is the whole of 2 halves. I mean, so there's opportunistic investing when things are going on sale. Everybody likes to go shopping when you're talking about clothes and everything, like, right? But what about portfolio shopping? So there's opportunistic investing that we have P's are down. You can buy some stuff on sale. That said, keep on dollar cost averaging. I mean, we can buy at high points, but we can also buy at low points. And so there's the core portfolio, then there's a satellite where we can do the opportunistic investing.
I mean, there's smart buying of sales too. Yeah. It's a difference between buying a shoe that's going to go on, that is on sale and is going to go out of style quicker, versus a shoe that's going to have some staying power that you might have some resale value on later on. Of course, that analogy aside, you think about how market participants are thinking right now, and they're thinking about tariffs. Tariffs are fueling fears of recession. How is your firm advising clients about framing a potential recession strategy here?
Well, sure. I mean, well, politics, they pander to people, Brad, but policy actually affects pockets. I mean, so no matter your political affiliation, these are real dollars. These are real people. That said, panic, that doesn't do any well. But that said, if we're talking about, well, let's reassess. Let's make some tactical shifts in our portfolio. Let's raise some cash. It depends on where you are in your life stage and where you are as far as time horizon is concerned. Mm-hmm. And if you look at those areas, then we can plan to help you prosper in ways that are according to your financial plan and not others.
You actually have some words of wisdom passed down from your parents, and you and yourself aligned with these. One of them is adjust your sails, don't abandon the ship. What does that mean?
Well, give yourself room to roll and adapt, as they said, my parents said. So you have to have some flexibility. I mean, we're going to have some substitution here. 10% of the high earners in this country constitute for 50% of the spending. Mm-hmm. So for those that are income challenged, it's going to be really tough. But for those that are high earners, well, we're going to see some swapping. I remember back in the day, my dad's a good barbecuer. We used to get brisket and ribs and all that, but those are expensive. But we also swapped that out for hamburger helper at times, right? So even if those high earners are going to look at their consumers' discretionary spending, travel, large purchases, second home buyings, home remodels, all of that, probably need to take a pause on that and have some cash to wade the waters.
Another is prioritizing earnings over extravagance. There's been a ton of extravagance about a few trades that has transpired over a couple years now, especially thinking about the AI elements of the market here. So just break that down for us a little bit.
Right. I mean, first of all, stay employed. Be gainfully employed. Keep that income coming in, right? Don't make any large decisions. I saw your last guest about businesses. Keep those afloat. Not making any large purchases there, but take the time to invest in yourself while the markets are down, because if you stay ready, you don't have to ever get ready. So when you're investing in yourself, then you can take care of opportunities when they come out of the gate, when it recovers.
And cash is still king in a storm. This is another one, of course, that we've heard rattle throughout Wall Street and just more broadly in much of our upbringings as well. So just break this one down for us.
Well, having too much cash is a sacrifice of opportunity. So, and that's warranting panic. I mean, so if 100% of your account is in cash, well, we're not continuing our dollar cost averaging strategy and all that, right? But there is time to prepare. And yes, there is uncertainty in the waters and unwarranted uncertainty that with the tariff activity. But if we don't have any signal of when that's going to end, then have some cash on hand. That way that will help protect from the panic selling.
And finally, hit a pause on lifestyle inflation. This one's going to be stepping on some toes, mostly mine. But what do you mean by hitting that pause button on lifestyle inflation specifically?
Sure. I'm a big proponent of lifestyle creep.
Yeah.
If your money's good, hey, look good, play good, pay good, right? That said, when times call, you need to take a pause. Hey, keep what's in your closet. If you have a planned trip, great. Don't plan another one, right? So enjoying yourself as far as your well-being and your wealth is concerned, fantastic. But that's what I'm saying. Take a pause, look at it. Don't do any more extravagant things in order to break your pockets.
I was just talking about that with our senior producer this morning here. Thanks so much for taking the time here with us in the studio.
I appreciate
it. Great to see you, Preston.
Yeah.
According to the Federal Reserve, consumer credit balances shrank by 0.2% in the month of February, with total outstanding balances coming in just shy of $5 trillion. American consumers may be pulling back on spending as the tariff-related sell-off rocked markets late last week. Here was some of the tips on financial housekeeping that could keep and help worried consumers out here. John and David Ottenschneider, the debt-free guys and hosts of the Living Not So Fabulously podcast, join us now. John, first, we got to know, what are some financial actions that you could take right now?
Absolutely. Yeah. So over the last couple of days, you've had guests on who've talked about how Americans have spent down their COVID savings. And for many Americans, that was also their emergency savings. So as always, our recommendation is to increase your emergency savings and pay off that high interest rate debt. If you do either of those two things, you're positioning yourself better than about 50% of consumers today. Also, if you're job insecure or you think you're going to be job insecure, update your LinkedIn profile, update your resume, start connecting with those old contacts you've lost touch with, obtain industry certifications on places like Coursera, and position yourself for the next opportunity if you need to. And finally, start your me folder in your email box. Start archiving all the praise that you get, all the accolades you get, any awards you might have received, even when people say thank you for a job well done. That way, if you need to, you have an arsenal that you can pull from to let your boss know how awesome you are.
All right, cool. I'm starting that now. David, what are some money habits to drop if you're worried about a possible recession?
I think probably the most important one is unconscious spending. I think we all get kind of accustomed to this idea of just spending and swiping that credit card, but many of us do it unconsciously. The key here is that you want to do a spending analysis, which is so easy today with apps like Empower or Rocket Money that actually allow you to look at a day, a week, a month, even longer to actually see where it is that you're spending. And so this really kind of leads into the second point of giving up this habit of winging it when it comes to your finances by not budgeting. More than 25% of Americans have said that they don't think that they need to budget, which may be part of the reason why so many people are living paycheck to paycheck. With the tools that I just mentioned, apps like that, it's so easy to refine our spending down to what truly makes us happy. And when we do that, we actually end up spending less. And then in line with your recent guest who was just previously on, avoid those lifestyle purchases on credit cards that you are not able to pay off right away because it's going to end up costing you more in the long run.
So John, what investment opportunities are there in a market like this?
Yeah, similar to what Preston said earlier, just adjust your sales a little bit. Maybe start dollar cost averaging in such a way that you can rebalance your portfolio. A couple of weeks ago, David and I were a little bit too tech heavy, and with the talks of tariffs coming up, we decided to start dollar cost averaging into some more conservative positions, even increasing our cash position just a little bit. And then always remember that there's a way to make money in almost any market. For example, you could sell some cash secured puts on a stock that you already want. You get paid now, and you could end up buying the stock at a discount later if the option gets exercised. If you're long-term bullish, which I think a lot of us are despite what's going on right now, maybe consider buying some leaps. You get some upside exposure with less upfront costs if you're able to buy the stock outright. And then finally, remember, even if you have losers in your portfolio by the end of the year, there may be an opportunity for tax loss harvesting when you start doing your 2025 taxes, as well as all the taxes going forward.
John and David, great to see you as always, and thanks so much for these tips. Appreciate it.
Thank you.
Thank you.
You can listen to new episodes of Living Not So Fabulously Wednesdays at noon. If you missed out on claiming the recovery rebate credit on your 2021 taxes, guess what? There's still time to act, but the clock is ticking. April 15th, in addition to tax day, marks the 3-year deadline to claim any returns or credits for the 2021 tax year. The recovery rebate credit is a refundable credit for individuals who did not receive one or more economic impact payments, also known as stimulus checks, or more colloquially as stimmies. Payments vary depending on several factors, but the maximum payment for 2021 is $1,400 per individual. The Internal Revenue Service has stated that most eligible taxpayers have already received their payments or credits, but found that over 1 million eligible taxpayers did not claim the tax credit on their 2021 taxes. For those people, the IRS issued payments back in January. But individuals who have not yet filed their 2021 returns, tisk, can still claim the credit. The IRS says even individuals with no earnings or minimal income may qualify. If that sounds like you, here's what to do. File your 2021 tax returns and claim the credit by April 15th, 2025. The money will be sent either by paper check or deposited via the banking information used on 2024 tax returns. Coming up, we're looking at some of today's trending tickers. We'll give you the news behind the moves next on Wealth. Let's get a quick check of the markets. We're just over 2 hours into today's trading activity here, and we've got some sizable gains here in a bounce effort. All I want to do is see you bounce with me is what Bow Wow used to say back in the day. Anyway, taking a look at the Dow Jones Industrial Average, you're seeing a little itty bitty bounce, Bow Wow, little type of bounce, if you will. It's up by about 2.7% here, and this is why it's little, because there you see the decline that we've seen over the course of the trading sessions in the immediate aftermath of Trump moving forward and saying that we're going to do the tariffs. And now, of course, all signs and clocks and kitchen timers are set for midnight tonight to see if those go into effect. We'll be watching that closely, as well as any ongoing talks and calls made into the White House from maybe China. We will see how that moves forward and transpires and what the White House disseminates from there. However, taking a look at the NASDAQ composite as well, we'll dive into tech in a hot second. NASDAQ composite's up by 2.9% during today's session. The S&P 500, you're seeing that up by about 2.6% right now. And taking a look at some heat maps. We heard you like heat maps, so we've got some good ones here for you folks, the best ones that you've ever seen, in fact. The XLK, that's where we're getting into that technology trade. You're seeing that higher by about 3.4%. All of the 11 S&P 500 sectors in positive territory. I promise you technology, I'm going to deliver, folks. Take a look at some of those Mag 7 names here, all of them in positive territory during today's trading session. And taking a look at NVIDIA here on the day, that's catching a bid right now. You're seeing it trade above 100. Of course, that psychological level that we've seen a lot of traders be tracking for good reason, especially as we had dipped below that, as you see earlier on in April. But one of the huge things that we're seeing, at least as of right now, is a little bit of a rebound despite the broader year-to-date pullback that we've been tracking in NVIDIA, down by about 23%. And then additionally, you've got Microsoft and some other shares that's still up on the day by about 2.9% right now. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now on set, we've got our very own Alexandra Canal, and we're taking a look at a couple of tech names making changes amid President Trump's tariff policy. So let's talk about Apple and Micron. First up, Apple planning to ship more iPhones to the U.S. from India to offset tariffs on China. That's according to the Wall Street Journal report. New tariffs on goods from China could raise the price to manufacture an iPhone by over 45%, from $580 to $850. That's according to Tech Insights. Because of this, some consumers are rushing to upgrade before tariffs can take effect. I'm checking my model right now. I'm at a 12 Pro Max.
I've been thinking about it. I drop my phone pretty often, so it's kind of cracked right now. And I'm wondering, do I just have to go invest?
I think you might just need to get a tempered glass screen.
I know. That's one of my problems here. But it really goes to show that tariffs obviously top of mind for investors, but also top of mind for everyday consumers when it comes to the products that we use every single day, like we were just discussing a lot of consumers weighing whether or not you go and upgrade your phone, you get a new iPhone. There's also been a lot of consumers going out there and trying to take advantage of deals from some of their phone carriers like Verizon, because there's been some speculation that once the tariffs hit, those types of discounts and promotions could go away. And I mean, Apple shares, they've just been rocked by these tariffs, off 17% over a 5-day period. Over $600 billion has just been completely eliminated from this stock. We're toward the lows of the 52-week range. And it's interesting because Apple is planning to spend $500 billion in the United States, which we know Trump loves. He's talked about that often, but this is a company that's very exposed to a lot of those heavily tariffed areas, like you think China, India, Vietnam, Thailand. So it'll be interesting with the amount that they're planning to invest in the U.S. if that leads to some exemptions or perhaps a de-escalation of sorts in the coming days and weeks ahead. And so far, no reciprocal tariffs have been implemented yet, but that's all planning to come tomorrow.
One of the reasons I need a new iPhone is because I can't even install some apps right now because it requires iOS 17 or greater. And
you definitely need a new iPhone, though.
Well, yeah, it has to happen. Next up, let's talk Micron. It's going to impose a surcharge on some products starting Wednesday as tariffs kick in, according to Reuters. Micron has manufacturing facilities in China, Taiwan, Japan, Malaysia, and Singapore, all subject to tariffs under President Trump's policies. So we're taking a look at shares here. They are higher by about 3.3%.
Yeah, but very similar story to Apple, right? I mean, down 20% over a 5-day period, low end of the 52-week range. Like we just said, heavily exposed to those tariffed countries. They do have U.S. customers that include technology companies, automotive companies, so potential trickle-down effect on the impact that we could see on the consumer side as well. Now, what's interesting here is that semiconductors were exempt from these reciprocal tariffs, but for a company like Micron, that just makes up a portion of their portfolio. And they did warn last month during their earnings call that, look, they are going to have to raise prices on those consumers. How much and the intensity of that remains to be seen. But again, it just goes to show how big tech is really vulnerable to a lot of these tariffs. And also, depending on what we see with EU retaliation, it also has me thinking of antitrust and what laws the EU could potentially say some of these U.S. companies are violating. So there's a big ripple effect here that really goes beyond tariffs when we think about some of the retaliation, I should say, from these bigger countries.
Yeah, for Micron, it's also going to come down to what they're saying about demand once they finally do report earnings. We're weeks away from that.
Right.
However, thinking through what the demand profile and the reception is to them potentially raising prices or adding this surcharge on and what they're hearing from customers.
Yeah, demand, and then also how heavily these companies are continuing to spend on AI. I mean, we know that's been a big priority for investors, but if these tariffs are going to eventually hit profits, are they going to pull back at all? And how will we see that reflected in the stock price?
Spot on. Allie, thanks so much for taking time. Coming up, everyone, understanding mortgage and loan options before you buy a house. We've got everything you need to know in the Home Buyer's Playbook. That's next on Wealth. It's Housing Week on Wealth, and we have the Home Buyer's Playbook with everything that you need to know every step of the way for the home buying process, from the planning stages to the closing process to the first year of home ownership. And today, we're outlining different mortgage and loan options for prospective buyers. Joining me now, we've got good friend of the show, Daryl Fairweather, who is the Redfin Chief Economist. Daryl, great to see you. What are some of the basics that prospective home buyers need to know as they start looking at mortgage options?
So the first choice to make is whether you want a fixed rate mortgage or an adjustable rate mortgage. The trade-off is that when you have a fixed rate, you know exactly what your monthly payments are going to be, and they will stay that way for as long as you have the mortgage. With an adjustable rate, there is a fixed period that can last for different amounts of time. But then after that, the rate resets at whatever the market rate may be, or something approximating that. So if you go with the adjustable, you're basically taking on more risk as a borrower because your rate can fluctuate with the market. That makes it cheaper for a lender to provide that loan, and you get a better deal, but you're taking on that risk. So that's a downside. With a fixed rate, you pay a little bit more, but you have that knowledge that it will always be the same. So you're taking some risk off of you.
And so our viewers hear us break this down every week with some of the updates for 15-year and 30-year fixed rate mortgages. But what are the core differences between the two?
Well, a 15-year mortgage, you're going to be paying off faster. So your payments are going to be higher each month, but you'll be paying less in interest because the term is shorter. And that means that you aren't paying it for as long. So that alone means you're paying less in interest, but also you'll get a better rate because you are committing to the bank that you're going to pay off this loan faster. So that's more valuable to the lender, to the bank. So if you have the money to do a 15-year or you're closer to retirement and you don't want to have a mortgage when you're 15 years out, then that could be a better option. But if you're buying a home, say as a younger person, you don't really have the money to go to the 15-year, but you're going to be staying in the home for quite a long time, then a 30-year might be a better option.
Is it as simple as that, or are there other types of home loans that we can consider?
Well, of course, there are adjustable loans, and part of the trade-off there is how long to keep your rate fixed. So that would be a 5-1 versus a 7-1, where you're fixed for 5 years versus 7 years, and then things reset. And then another option, which isn't so popular anymore, but is still out there, is having an interest-only loan where you are paying the interest first, not affecting your equity. That means you're going to end up paying a lot more interest over time, but that can be a good option for people who plan to sell the house again in a short amount of time.
And so what are some tips to help prospective home buyers get the best mortgage?
Definitely shop around. You want to talk to multiple lenders. This is easier than ever nowadays because you can just go online, put in your information, and you will get multiple lenders reaching out to you, telling you what their loan terms are. So it's super important to shop around. Also, look at that down payment. How much you put down is going to affect how good of a rate you get. The lower the down payment, generally, the higher the interest rate you're going to be paying. And also on top of that, you're borrowing way more money. So that's a higher interest rate on even more debt that you're taking out. So you can end up paying a lot more in interest. If you have a small down payment, you can really reduce that interest amount if you put in a higher down payment.
And so, as we kind of go through the calculus, or at least some of the prospective home buyers consider an existing home versus a new home, does that change the type of conversation that they're having with their potential mortgage lender?
Well, with new construction, sometimes the seller of the new construction will buy down your rate for you. It's been more common since interest rates went up and a lot of builders are just trying to make sales happen. You can also negotiate, though, with an existing homeowner who's selling for them to buy down your rate, too. You can always ask for the seller to help you get a better rate. So with new construction, they're a little bit more willing to work on that. Another consideration with new construction is a lot of the times people are committing to buying the new construction before they fix their interest rate. And that can add risk to the situation because you really don't know what your monthly payment is going to be until you lock in that rate. So that's just another consideration with new construction.
Daryl, congratulations on the new book as well. Know it's coming out, hidden shelves. Appreciate it.
Thank you.
You can scan the QR code on your screen to use Yahoo Finance's mortgage payment calculator, revealing your estimated monthly payment with principal and interest estimates built in. Let's do a final check of the markets as we've been looking at green, wealth-themed green on the screen throughout today's trading activity here. We're seeing gains of 2.4% for the Dow Jones Industrial Average, about the same on a percentage basis for the NASDAQ Composite and the S&P 500, also steadily in the green by about 2.3% right now. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. They'll count you down to and through the market close.